The stock market is over, and you should get out before Trump triggers a full-blown recession. That's what the mainstream media wants you to believe. Headlines are screaming disaster, social media is in a frenzy, and everyone, absolutely everyone, is asking the same question: should I sell now before it gets even worse? But hold on, there's so much more to this than meets the eye, isn't there? If you've been following Finance Compass, you know we're about more than just reacting to the noise. We're about understanding the underlying currents, the forces that truly drive the market. And since many of you have entrusted us with your financial journeys, we feel a profound responsibility to give you our honest take on this situation. So before you hit that panic button, let's take a deep breath and look at the bigger picture together. Every significant market downturn has a cause, a catalyst. This isn't random chaos. There are three main triggers contributing to the current volatility, and yes, they all tie back, in some way, to one man: Donald Trump. Now, before anyone jumps to conclusions, let's be absolutely clear. This isn't about politics. We're not here to endorse or condemn. As financial analysts observing from a global perspective, our sole concern is how these events impact you, the investors. So let's break down these three critical triggers, analyze why they matter, and most importantly, explore how you can potentially benefit from this perceived mayhem. Trigger 1. Trump's trade war. A déjà vu of economic history? Donald Trump has always positioned himself as the ultimate deal-maker, the champion of American jobs, the negotiator who plays hardball with other nations. But are these trade wars he's waging truly in the best interest of the average investor? Could they, in fact, increase your weekly shopping bill and potentially trigger a recession? The historical parallels are, frankly, concerning. The last time the United States embarked on a similar path of aggressive protectionism, it contributed to the Great Depression, a period of devastating economic hardship. Jobs were lost, businesses collapsed, and the economy was utterly wrecked. Now, are we on the verge of history repeating itself? Stocks are certainly showing signs of distress. Prices are rising, and if this situation spirals out of control, it won't just impact Wall Street, it will hit you, right where it matters most: your bank account. Let's rewind to 1930. The U.S. government, seeking to protect domestic industries, implemented massive tariffs on imported goods through the Smoot-Hawley Tariff Act. The initial premise was simple: shield American companies from foreign competition and boost domestic production. However, the consequences were catastrophic. Other nations retaliated, imposing their own tariffs on American goods. Global trade ground to a halt. Businesses failed, and millions found themselves unemployed. Instead of mitigating the recession, this policy exacerbated it, transforming it into the Great Depression. Fast forward to 2025. Trump has revived the use of tariffs with renewed vigor. In February, he announced a 10% tariff on Canadian energy imports and a 25% tariff on other Canadian goods. Canada, in response, imposed a 25% tariff on American imports. Then, in March, Ontario implemented a 25% surcharge on electricity exports to the U.S., affecting states like New York, Michigan, and Minnesota. While the Ontario move was arguably more symbolic, Trump's reaction was anything but. He escalated the situation by increasing tariffs on Canadian steel and aluminum to 50%. This was a direct blow to Canada's manufacturing sector and drove up steel prices for American businesses reliant on imports. Now, why is this important? Because tariffs, while seemingly designed to punish foreign businesses and promote domestic production, ultimately burden the consumer. As a business owner who deals with international supply chains, I understand firsthand that increased costs are passed on to the customer. This translates to higher prices for cars, appliances, electronics, and even food. Essential goods become more expensive, straining household budgets. Furthermore, other countries are not passively accepting these tariffs. They are actively forming new alliances to bypass the U.S. China, for example, is leading the BRICS alliance, partnering with Brazil, Russia, India, and South Africa to reduce their reliance on American trade. The more the U.S. isolates itself, the more other nations seek alternative trading partners. So what's our take on this as experienced analysts? If Trump persists with this aggressive trade war, historical precedent suggests it will cause more harm than good. While certain industries might experience short-term gains, the long-term consequences, higher prices, weakened global ties, and a slowing U.S. economy, could outweigh any potential benefits. However, here's a crucial point. We don't believe Trump genuinely desires high tariffs. He is, at his core, a businessman and a negotiator. We believe he's using tariffs as a bargaining chip, a tool to achieve a larger objective: free global trade on terms that favor the U.S. If he succeeds, the potential payoff could be substantial. The problem, however, lies in the uncertainty his approach creates. The constant policy reversals, new tariffs, and mixed signals are unsettling the stock market. Investors abhor unpredictability. If this situation drags on, it could erode confidence to the point of triggering a recession, a risk even the Trump administration acknowledges. Currently, the market isn't reacting solely to tariffs. It's reacting to the ambiguity surrounding what comes next. And in the realm of investing, uncertainty is a confidence killer. Trigger 2. Trump's stance on NATO. A shift in global security? Trump's questioning of NATO's role, the military alliance that has been a cornerstone of Western security, is another source of market anxiety. His suggestion that the U.S. security should not defend allies who fail to meet their financial obligations raises concerns about a potential power vacuum. If the U.S. were to reduce its commitment to NATO, it could embolden countries like Russia and China to expand their influence. Any perceived instability in global security triggers market panic. A weakened NATO could lead to increased Russian aggression in Europe, or even new conflicts as nations adjust to a world without the U.S. as the primary global security guarantor. Increased conflicts lead to higher military spending, unpredictable trade relationships, and spikes in energy prices, all factors that destabilize the stock market. Trigger 3. Trump's secret plan. A calculated market crash? A theory circulating suggests that Trump might be deliberately orchestrating a stock market crash. While this may sound outlandish, there's some evidence to support it. Trump has consistently criticized high interest rates, labeling them ridiculous, and openly attacking the Federal Reserve for maintaining them. The Fed, though technically independent, bases its decisions on economic conditions. A stock market crash and the threat of a recession would force the Fed to lower interest rates to prevent a complete economic collapse. Why would Trump want lower interest rates? High interest rates slow economic growth, hindering businesses and impacting stock performance. For Trump, who prioritizes growth and projects an image of American strength, this is unacceptable. But there's a larger strategic element at play. The U.S. government is burdened with a staggering $36.5 trillion in debt. High interest rates significantly increase the cost of servicing this debt. Lowering interest rates would allow the government to refinance its debt at a lower cost, saving billions if not trillions in interest payments. This strategy isn't unprecedented. If Trump can create the conditions for a Fed rate cut, it could be a masterful economic maneuver. If this theory holds true, we're not witnessing a long-term economic collapse, but rather a temporary market correction preceding a substantial rebound. How to benefit from the crash? Market crashes, while unsettling, are a normal part of the investment cycle. History demonstrates that every U.S. market downturn has been followed by a recovery. Those who panic and sell typically incur losses, while those who remain calm and invest strategically often emerge victorious. This is not a time for fear. It's a time for preparation and strategic action. Step 1. Invest while the market is down. Before investing, ensure you have a solid financial foundation, an emergency fund of 3 to 6 months living expenses, and the elimination of high-interest debt. For those new to investing, this market downturn presents an opportunity to buy stocks at discounted prices. During the 2008 financial crisis, investors who remained steadfast reaped significant rewards. Step 2. Stay disciplined and think long-term. Understand the market's cyclical nature. Corrections, bear markets, and full collapses are all part of the investment landscape. Avoid emotional decision-making. Resist the urge to panic sell. Instead, consider increasing your investments during downturns and adopt. So, there you have it. The market's turbulence, the potential triggers, and the strategies to navigate it. Whether it's Trump's trade war, the shifting sands of global alliances, or a calculated economic maneuver, one thing is clear: uncertainty breeds opportunity. Remember, Market downturns, while unsettling, are not the end of the world. They are, in fact, an inevitable part of the investment cycle. The key is to remain calm, stay informed, and act strategically. Don't let fear dictate your decisions. Instead, use this volatility to your advantage. If you found this analysis helpful, please hit that like button and share it with anyone who's concerned about the current market conditions. And if you're serious about building wealth and navigating these complex times, subscribe to Finance Compass and ring that notification bell so you don't miss our future insights. We're here to guide you through the noise and empower you to make informed financial decisions. The market may be unpredictable, but your approach doesn't have to be. Stay disciplined, stay informed, and stay focused on your long-term goals. Thank you for watching, and we'll see you in the next video.